It isn't hard for me to explain. I mean, when you have conviction in something as a necessary innovation to help solve some of the world's problems, I've had, my background is both economics and finance. So, I feel very confident in what I'm saying. This is the first global, private, digital, rules-based monetary system. When I'm explaining it like that, I ask everyone to listen to each of those words. Each one of them is very important. And this is one of the most profound innovations of our time. So my conviction, and it's born out of our research, it's born out of great research that Yassine, Frank, and David are doing now, as well as what Chris has done, and the community largely. So there's no doubt in my mind. Many people think that I'm too confident, not just with Bitcoin, but all of our strategies. We face the same kind of pushback with all of our innovation strategies. This is nothing new. This feels the same. It's a little different to explain, but it's not a company, so more finance, but it's a monetary system, which is economics, and I'm comfortable in both of those zones. We average down and concentrate into our highest conviction stocks. Now, if you only have two assets, you and Bitcoin, I guess that's a little bit more difficult to do. But we started out last February 21, we had been up 360% from the bottom of the coronavirus in our peak in February of 21. And during that time, we expanded the number of stocks in our portfolio because we had been highly concentrated at the bottom in COVID towards our highest conviction names. And so we went from roughly 33 names to 58 names. There were IPOs, there were lots of exciting opportunities. And then starting February of 21, to our low in May, and we think that's the low, but we're getting close there again. You never know. The Fed, I do believe, is a big menace here. We were down 75%. Our strategy is maybe a percentage point less than the S&P 500 or the NASDAQ, which was single digits. But if you're telling me that after this bloodbath, I'm saying, oh my gosh, if we, this is a great setup for the future if we're just behind by that much, because we are so much more volatile than the benchmarks. And, there is going to be a change there too. When the shift away from benchmarks happens, we will be the self-fulfilling prophecy, or we will be the beneficiary of the self-fulfilling prophecy or self-fulfilling trend, which is away from benchmarks towards innovation, because it's going to become so obvious. So that 75% decline, why does that happen? It happens because most portfolio managers, even the active ones, so they really are trying to invest, they're still investing close to their benchmarks, and they don't want to be so far away from their benchmarks. Our stocks are not in benchmarks except for Tesla. And so Tesla, believe it or not, has held up better than most of our other stocks because it's in the benchmarks. When risk on happens, then they all start migrating and taking positions in some of our names. And so that gives us the lift. We just published an open letter to the Fed today and basically said, wait a minute, how can you be unanimous in your decision-making, you Fed board members, unanimous at the last few votes, when there's so much conflicting evidence out there? And yes, we feel as though the Fed is making a mistake here, and that yes, high beta stocks, which would be our kinds of stocks, more volatile than the market. But something's happening now, and it's happening with Bitcoin as well, which I find very interesting. So our strategy bottomed intraday, the flagship, on May 12th. And the S&P and NASDAQ have broken below their lows. Last week, they broke below their last lows. We did not. Now, maybe I'm jinxing myself, and we will now, but our strategy has held up better since May. And same with Bitcoin after the volatility in May. It's held in much better. It hasn't hit new lows, successive new lows. It's in a range, much like our strategy is. During a bear market and towards the end of a bear market, our strategy starts outperforming. Why? There's a saying in our business that the new leadership shows itself toward the end of a bear market. It starts outperforming. So at the end of 08, 09, for example, I was at a different firm, but our flagship strategy, bottomed in relative terms November 24th, and the market didn't bottom until March of 09. And in the first quarter, the market, as measured by the S&P, was down 10%. We were flat. And then we came out flying. And I'd like to think that's what's going to happen. The problem is the Fed here. And in the piece we wrote today, we said, please consider the conflicting evidence and at least debate. Talk about the risk of centralization. This is a massive risk because it's not just the Fed, not the Fed board members. It's probably one member, and that's Powell, who's insisting on unanimity in their fight against inflation. So what they're doing, what they've just done, is raised interest rates 13-fold from 0.25 on the Fed funds rate to 3.25, and they're going to go to 4, we believe, on November 2nd. That's a 16-fold increase in interest rate. What he's doing, I think Chairman Powell thinks he's the reincarnation of Chairman Volcker. Now, I was early in my career during Chairman Volcker's reign, and he was fighting an inflation that really started with the Vietnam War in 1964, April, and then in May 64 was the Great Society, all of these social programs that President Johnson launched. That was the beginning of the inflation that Volcker inherited in 78 or 79, 15 years, and it was embedded. It was cost push. People had gotten used to working around inflation, demanding certain wages and so forth. By the time the Fed recognized that it might have overstayed its welcome, it was maybe 15 months. That's a lot different. And this has been associated with supply shocks every step of the way. COVID, supply chain, Russian war. It's hard to separate out. And I think the key here, and this is where I'm going to have the biggest argument with the people who really think inflation, the genie's out of the bottle. I believe the velocity of money now is going to start falling again. It actually peaked in 97, has been falling. It falls at an accelerated rate during crises. And if the velocity of money starts falling now, that M2, it looks like M2 is going to come in below 3% year over year for September. If velocity is falling on top of that, that means nominal GDP growth is flat to negative on a year-over-year basis. That's a killer for companies' profits. Now, in this environment, the reason why we would start outperforming is because our fundamentals are better. We're the new world. Our revenue growth is much stronger than GDP. And in times of turmoil and trouble, again, innovation solves problems, revenue growth accelerates. Certainly that was the case in COVID. And I think the carnage of certainly in 2021 for us is, our strategy being dismissed by many old timers in the industry as, just a stay-at-home COVID strategy. All those stay-at-home stocks are now going to go into negative growth, which has not happened. I think the Fed is a problem. I think they're making a mistake. I think the world is paying for it. If we think there's pressure here, the emerging markets, we're going to ruin our status as world's reserve currency. And I remember there was a similar situation in the 80s, but we responded to it when the dollar was causing so many problems for the rest of the world. Treasury ministers from around the world got together in 1985. There was both the Plaza Accord and the Louvre Accord, and they agreed to sell dollars and buy back the other currencies to support those other currencies and to prevent the deflationary bust that was being caused by currency implosions in the emerging markets and their debt service exploding because it was dollar-denominated debt. The same thing is going on now, and I think we're going to see more rips in the fabric of the global financial system. I think what happened in the UK around pension funds was really more about banks. Those pension funds weren't going to meet those margin calls, and that was the banks were the counterparty. They had to come in. So the BOE has already reversed its monetary policy. What are these pension funds selling so that they can be made a little more right, instead of upside down? They're selling the easiest financial instruments to sell. Treasury securities, government bonds. We've got the BOE reversing. You've got the Bank of Japan and the Chinese central bank, PBOC, both of them are supporting their currencies. What does that mean? It means they're selling dollars and buying their currencies. So it's freeing up some dollar liquidity, and there is a dearth of dollar liquidity out there. So I think we're going to see many other central banks doing that. But I also think when the ministers meet, the G20, in November, that the odds of another Plaza or Louvre Accord type agreement are going to be pretty high, because I think that we're seeing a lot of deflation for cyclical reasons, and then secular reasons as well. Innovation is deflationary, but good deflation. It causes bad deflation for companies that are going to be disintermediated or disrupted or destroyed. So, do
you see a growing interest again in Bitcoin right now?
We get questions all the time. I think people love to hear our take on, in the way I just described Bitcoin, that's the money revolution. And then we have the financial services revolution, DeFi, a little more centralized, and then we have the next generation internet revolution around digital property rights. And I realize all of these involve property rights, but when you're talking about the creator economy and the blending of consumption and investment, it's probably even more centralized and in that third bucket. I think when people hear us describe this new world, especially young people, it hits a responsive chord. And the young people are bringing their parents into it. So that's an interesting dynamic. That really hasn't happened in my career before.